Good morning, everyone. Thank you very much for coming. So Imre and I are going to be running you through some of the highlights of our latest quarterly overview, which we published last month, and talking a little bit about things that have happened since. It's always fun trying to do a new set of forecasts right ahead of an event that you know has got a lot at stake and is looking 50-50, but that's the life of a forecaster. Okay, so the theme for this one was back in the band. Now, more specifically, inflation is now finally back within that 1 to 3% band that the Reserve Bank is tasked with maintaining over the medium term. So the headline measure, as we know, is now down to 2.2% inflation, but also not just the headline one, but also these various core measures. So they're trying to strip out volatile stuff or quirky or one-off things and try to get to the picture of what's really going on underneath. Most of them are also back within the band, albeit not sitting comfortably at that 2% midpoint just yet. So this is a genuine move. It's not just sort of something that's come about through government subsidies, as we've seen in Australia. This return to the band, it hasn't been a surprise in itself. In fact, if you actually go back, look at the forecasts that were made 2 years ago, so whether it was us or the Reserve Bank or other market forecasters, September quarter of this year was really picked as the time that would be back below 3%. So the timing hasn't been a surprise at all. Monetary policy works, guess what? But it is one thing to forecast it. I think it's different. There's another level of confidence that comes with actually being there. So it's a big deal for forecasters like us because we like to have bragging rights, but it is also a big deal for the Reserve Bank because it means that at this point, monetary policy can move away from dealing with this immediate problem and go back into its normal task of managing two-way risk. And it is genuinely two-way risk, as I'll sort of hopefully leave you with here. This is not simply that inflation's done and dusted. To use an analogy that my colleague Satish has used, the inflation dragon is back in the cave. It hasn't been slain for all time. It's there to re-emerge if conditions are right. While we maybe haven't seen a big surprise on the inflation front, there has been a lot of whiplash in terms of monetary policy. If you think back 6 months ago, back in May, I think the Reserve Bank at that point was starting to lose the faith a bit with inflation actually coming under control quite as soon as they were hoping. And they were putting out these projections saying that the cash rate would remaining high for quite some time. And in the year ahead, there's maybe even more risk that the next move will be up rather than down. So 3 months after that, in August, they'd cut. And then another 6 weeks or so after that, in October, they'd delivered an even bigger cut. And while they didn't give a signal at that point of what's happening next, I think probably by omission you could say that they were happy for the market to keep pricing in big cuts in the months going forward. So what's caused this rapid turnaround? I think you hear a lot about they're cutting rates because the economy is weak. It's so weak, they've got to prop it up. It's been so weak. It has been weak, but you've got to bear in mind that the Reserve Bank has always been expecting it to be weak at this point. They accepted that as part of the price of getting inflation down. And in that respect, it hasn't really been any weaker than they expected it to be at this point. Now there's been, along the way, maybe a bit of a head fake in some of the data through the middle of this year. But generally we've been on, I think, the same path that we've been on for a while. It's this shallow but quite drawn out recession. So I think what has changed a lot in those last 6 months is that there's a lot more evidence now of pricing pressures coming under control. So we're really seeing businesses are finding it much harder to increase their prices in the way they were before. While they're not necessarily seeing a lot of relief on their own costs, they're not able to pass it on and they're having to take the squeeze on their margins instead. And that's something that really wasn't clearly the case even as little as 6 months ago. We've got much more evidence of it now. Now, there are some areas where prices are still rising pretty quickly. So there's I think the well-reported things like council rates, insurance, seen some pretty rapid increases in the last year. Now, I think some of these areas, they're kind of dealing with the legacy issues and they're having to go through a repricing of their own. So they'll probably be going up quickly regardless of what general inflation was doing. But if you take those kind of things out, look at the stuff that should really reflect what's going on with the overall economy, that has noticeably come back, which again wasn't clearly the case. It was still running uncomfortably high earlier in the year. Okay, so we're on to our first Slido poll. Now that inflation's back within the band, where do we go next? So the question here is, how low do you think the annual inflation rate is going to get in the next few years? I'll let you figure out the time frame for that. I'm not going to say, within X time frame, but just at any point in the next few years, what's the absolute low that inflation rate's going to get? Is it going to be, about here? You remember the last reading's 2.2, so that's your upper limit for these answers. Is it going to be a little bit below the midpoint, a bit more below the midpoint, or are they going to overshoot and go the other direction for a while? Interesting. That's actually, it's not far from the responses that we had last time we were here. I think it was about half of people said that it would bottom out above 2%. So you're consistent at least, great. I was expecting a little bit more on the downside, but no, very interesting. For our own part, our forecast for the next couple of years, it's fairly steady looking. The low point in that track is 1.8% next year. Not to be too precise about it. So going a bit below 2% is fine. The inflation target is specified in a way that it allows for some flexibility around that. And I think the Reserve Bank governor, when he was over in Washington last month, was doing some interviews and speeches and so on, he said something to the effect of, in his mind, anything between 1.7 and 2.3, he's not going to lose any sleep over. It's close enough. But within that overall steady looking forecast, there's a couple of moving parts going on within there. So if either of those goes wrong, or both, then we could end up with a quite different result. So I think that really helps to highlight some of the risks around this forecast, and I'll get into those. So we sort of very broadly tend to divide up inflation into what's called tradables and non-tradables. It's essentially things that are affected more by global forces versus things that are affected more by local conditions. So I'll start with the tradables, the ones that are driven more by global forces. Now, we've actually seen a lot of the taming of inflation to date has been through that tradables inflation coming down and actually those prices starting to fall again. So in other words, the rest of the world has actually done a lot of the work for us, which is great. We can't deny that it's happened, but can we rely on that to continue? Now, I think this is in the context of a world economy it's really sort of running neither hot nor cold. So in terms of what we're expecting for growth among our major trading partners, we're really looking at a couple of years of okay growth, kind of more of the same. And it is also, bear in mind, in the context of what's really starting to become a more or less global easing cycle for monetary policy. So a lot of countries are in a similar position to us. They've pretty much knocked inflation on the head. They're now starting to lower interest rates. How far they lower them, we'll see. But they are turning from, effectively having their foot on the brake to, taking it off, maybe stepping on the accelerator to get things going again. Now, there are some exceptions. I think Japan is actually unusual in that it's starting to tighten monetary policy for the first time in 25 years or something like that. In Australia, their approach was they chose to do the bare minimum to meet their inflation target, and they've certainly done that. They've done the bare minimum. They've left themselves no wiggle room for anything like rate cuts in the way that, was certainly not this year at least. Honing in on one in particular, so China, pretty important for us for various reasons. They are our biggest trade partner in both directions. They're also our biggest source of imports. So what happens with their prices is going to have a big effect on those, that import-driven inflation. Now, they've really been going through a period of what's quite subpar growth by their standards. 4 to 5% would be stoked at that, but for them it's inadequate. And they have been looking at some stimulus measures recently. There have been some announcements. I think there's a general sense that what they've said to date is not enough, but there's also a widespread expectation that there's more to come. They'll keep rolling it out. But one thing they have been doing for a while now is, rather than trying to stimulate demand within China, they've really been pushing the production side, so producing more and then trying to find a market for it around the world. So there's been a lot of Chinese exports, even more than usual, I guess, hitting the global markets. Those prices for their manufactured goods are now falling as fast as they were after the GFC. So not surprisingly, that is starting to show up in our import prices as well. Do they continue with this, or do they do something to actually stimulate some of their demand within China and find a market for those products? It's one of the big unknowns. The other one is Trump. Now, I'm not going to dwell on all of this text here. In fact, I think if you're watching the video of this later, you may just want to pause it here and have a read of that. But I think you can tell a story of a few things together. So one is in the US, a more stimulatory fiscal policy, mostly through lower taxes than we would have had under the Democrats. Secondly, tariffs, whatever happens with those or to what degree it happens. We're talking higher prices within the US, lower returns for countries that export to the US, unless there's an exchange rate adjustment to offset that. And then finally, just general geopolitical uncertainty, which tends to create a safe haven demand for the US dollar. You can combine all those and say this is going to be a strong US dollar story, and consequently a weaker Kiwi dollar. Now, certainly, markets already know these arguments, and they have been pricing it in recently. So even before the election, and certainly a bit since the result. So there's no real disagreement about the direction, but it's about the persistence of it. Is this something that just really warrants a one-off repricing of the US dollar, or is it something that will lead to an ongoing trend of a strengthening US dollar? Now, in our forecast, we've lent more towards the former. So we do have, over the longer term, still a mild softening of the US dollar. And then within that, it means Kiwi gains a bit against US, but underperforms against other currencies. And that's sort of more around our thinking around some of these persistent issues like our annoyingly large current account deficit. But if we don't get that story, if it's stronger US dollar forever, or as far as the eye can see, that to us, I think, would suggest a markedly weaker Kiwi dollar. And that may mean that import inflation doesn't behave quite as nicely as we would hope. All right, the other aspect of it is what happens with domestically driven inflation. And this is just coming down to the degree of slack in the economy and just how quickly we're growing or not. So next question, what do you expect GDP to do over the next 6 months? Now that we've had these interest rate cuts, when are we going to start to see the effects? Is it going to be, we're going to be about the same for the near foreseeable future? Is it going to be things picking up, or have we actually still got the worst yet to come? All right. So it's reasonably close. Most people saying about the same. I think last time we probably had the majority on B, so we've got more people in favour of weaker. Also, not more people saying strengthen. And a couple of you, maybe ANZ customers, are responding to their business confidence survey. Best conditions in 10 years. Let me know who's finding that. So for our part, I would say that we're on B. So in our forecasts, we've got another small minus for the September quarter. So that's the number it'll be coming out just before Christmas. And then for the next couple of quarters, it's some pretty small growth. So that would be, I'd say, next 6 months would say flat, about the same. It's really not until we're getting into second half of next year before we're sort of expecting to see some noticeably healthier growth numbers. The usual rule of thumb is that interest rates, or big changes in interest rates, have their biggest impact on the economy 1 to 2 years ahead. Now, it's not that they suddenly start working after 1 year. It's just more the cumulative effect is really strongest once you're getting to a year or two later. So that's really why we're sort of expecting the impact on growth to be coming, more like a year or so after those falls in interest rates started to happen. Within that general rule, because it is a rule of thumb, there are always some parts of the economy that respond faster than others, and some quite a bit slower. The one that typically responds fastest is the housing market. And that in turn does have knock-on effects for the consumer through the wealth effect, which we tend to see operating quite strongly in New Zealand. So, next poll. The favourite topic, the national sport, speculating on the housing market. What are house prices going to do over next year? So I think for this year, we're probably looking at them being about flat for the year, I think. So is it going to be up a bit, up a lot, or is it going to get worse before it gets better again? Okay, so I'd say that's mostly probably up by around the same as household incomes. So sort of nice and sideways in terms of affordability, and a few more optimists in there. We are currently expecting an 8% rise in prices for next year. That was up from 6% in our last quarterly. Now that maybe sounds like a big number. I think for some metrics it would be quite a big increase in 1 year. I think it's actually quite a modest expectation relative to the interest rate boost that the housing market is and will be getting over that time. So I think that number, why we're not talking double digits, it's really just acknowledging that there are still quite a few headwinds against the housing market. There is right now still quite a log jam of homes on the market. I think in a way we firstly sort of need buyers to come up to reach the asking prices that sellers are expecting before we start talking about prices actively being bid up. Affordability is coming from, I think, still quite a stretched starting point. It's never, improved as much as it has tended to do in previous cycles. And the debt to income limits, which came in, I think, July this year, could potentially work as an automatic stabilizer in the way that loan to value limits didn't. So the idea is that if house prices start to rise faster than incomes, then it starts to become more binding. And that didn't happen with the LVRs. So there's a bunch of reasons to be semi-cautious, but still optimistic about the housing market. The other aspect is, I guess, what do existing homeowners, or when will they start to experience the benefits of this? This is probably actually one of the most common questions we're asked is when are people refixing? And that one's an easy one to answer because we're all using the same data. It's coming from the Reserve Bank. I think it's been thrown up on Twitter and people's weeklies and so on many times. But essentially, people have been tending to fix for shorter periods in the last couple of years. So we've now got at the moment about half of all lending is going to be coming up or can be reset within the next 6 months, about 30% within the next 3 months. And that's different from going back a couple of years where people were tending to go shorter and trying to lock in those low rates. So that means that in one sense, the transmission of interest rates will happen sooner than it did when rates were going up. The other aspect of that is that the increment of change is not as large as it was in the previous direction. We just haven't seen interest rates move as dramatically on the way down as they did on the way up, going back a couple of years. So what kind of benefits are people looking at? Now this is just one way of slicing it up. There's no one right way of doing it. So for instance, this is looking at sort of the old and new mortgage rates, but assuming that people go on to the same term that they were on before. In practice, people will probably go on longer terms where the rates are lower. So these folks on the left are probably going to be fixing at something with a 5 in front of it and getting a bigger benefit than this chart suggests. But essentially what it's saying is that if you had last fixed within the last year, at your next reset, you're looking at a pretty big step change in terms of those minimum payments. If you fixed 2 years ago, you will get a slightly lower rate, but not hugely so. If you fixed 3 years ago, you haven't actually fully experienced the tightening yet. You're unavoidably going to be going onto a higher rate. But that last group is relatively small. Most people are in, as I said, in that first two. So on balance, people will still be getting a lot of cash potentially freed up in terms of their budgets. Businesses. When are businesses going to pick up? As I said before, business confidence surveys looking pretty perky about the future. Certainly not the past, but the future outlook are looking pretty perky. That said, once you get into the more specific questions you ask businesses, what are you actually going to do in terms of hiring, in terms of investment and so on? It's up, but it's a more modest increase, I think. It's certainly not shooting the lights out on those measures. What we tend to find, this is one of the more lagging things, and generally businesses don't really look into investment until they see the dollars, until they're seeing their profits themselves pick up. So given the usual lags in these things, we're not really expecting much for the year ahead. It's probably a bit longer than that before we start to see a pickup in capital investment again. In construction, one of the sectors that is finding particularly hard at the moment. We kind of see how the lag works in this area because we've got the pipeline of what's been consented, and those consent numbers have come off a lot from their highs, and we're seeing that in terms of the amount of work that's on is still drifting off. Now those consents, at least for housing, there's maybe signs that they've reached a bottom. You've got to sort of look through some of the monthly jumpiness in those, but it looks like they're starting to bottom out, and I think lower interest rates, some of the sort of push to sort of reduce regulation will help that to recover. But we're still in that phase where the pipeline of approved work is running down. So again, this is something that it's probably going to get worse in the next 6 months before we start to talk about it getting better. And labour market, this is really one of the last things that tends to respond. In fact, it's only quite recently that we've seen the economy turn to outright job losses. Part of that, I think, is that last year we were getting a big population boost from really high, in fact, I think pretty much record high migration. So there's just more people around. There was more demand as well as more supply of workers. And it's only more recently that we've kind of seen things turn from not just a slowdown in hiring, but to outright job shedding. So given that, it's probably got a way to go before it runs its course. So what's that going to mean in terms of, and I've probably actually sort of anchored your expectations on this one already, sorry. Try to give honest answers about this. Where do you think the unemployment rate is going to peak in this cycle? So we've gone from a low point of 3.2. We're now on the reading that came out last week. It's now at 4.8. So how much further do we have to go? All right. It's looking mostly like something with a 5 in front of it, and possibly a bit worse. All right. Yeah, I think I kind of agree with that. In the document, we had a peak of 5.6. After last week's numbers, we had a look at that and shaded down that peak to 5.4. So we're in A now. We were in B. That shading down was just a bit of a cosmetic thing, really. We're finding that participation in the labour force is absorbing some of the hit, probably a bit more so than we were expecting. We think that'll probably stick, and that just means that measure of people who are actively looking for work maybe doesn't peak as high as we thought. But other than that, it's not really conveying anything about the strength of the economy or the degree of pressure in the labour market, and hence the degree of pressure on wages. Those people that have dropped out of the workforce for now, they're there to come back into it when the jobs are available again. So yes, that was our forecast for that one. And as I mentioned, wage growth. This is often the very, very last shoe to drop in the cycle. And it's felt like it's taken a while for that one to turn around. Part of that is because the total measure in recent times has been boosted quite a lot by collective agreements in the public sector. Now, they were agreed a little while ago and then rolled out in stages, so they're sort of still coming through in the wage measures. I understand there's one more to come for teachers in December. So after that, we're kind of back to normal, and I think I would expect by the end of next year, those red and black lines should converge. But taking out the public sector side, looking at what's the market-driven wage growth looking like, that has now clearly come off from its highs. It's still not quite back at something that's consistent with stable inflation, at least on the annual measure. I think maybe the quarterly measures are starting to look a bit more like that. So there's been genuine progress in terms of bringing that down. And I'm not saying, yay, lower wage increases. But it's more about, this has really been a key part of taming the inflation dragon. Because a lot of that stuff that's still been running persistently high, a lot of it's services and a lot of it's quite labour intensive. So this is the one biggest cost that is kind of driving that cycle of price increases beget price increases. You've really got to break that one, and it's difficult to do it painlessly. I think maybe the US came close to that, but not entirely so. Okay, now finish up with the bottom line, cash rate. So in the immediate future, we are expecting another 50-point cut at the meeting later this month. Now, it's for any one meeting, it can come down to tactics as much as it comes down to economic conditions. So there's all sorts of arguments you can make about it for a bigger move or a smaller move. I'm not going to dwell on that here, but we are putting out our preview note for that decision later today. So you can sort of get the arguments on that one in detail. Beyond that, we are expecting the pace of easing to slow down. So it's really been a front-loaded easing cycle. We have 3 more smaller cuts coming in the first half of next year, and then we're looking at a low point of 3.5. Again, without being too precise about things. I think one thing that has changed in a set of forecasts this time is that we do now think that the cash rate will be spending sometime modestly on the lower side of neutral. Now, what's neutral? I'll gloss over that for just a second, but essentially, we're saying that at the moment, monetary policy is about taking the foot off the brake. By middle of next year, we think that they will be pressing lightly on the accelerator. Now, within that, there's a range of possible outcomes. So, you never want to sort of bet the farm on a single cash rate forecast. I can certainly see there's a range of scenarios where the Reserve Bank just keeps going, well, inflation's low, economy's weak, we'll just keep cutting. And there's, potentially a wide range of end points or low points for the cycle. There's also I think some scenarios, probably a more specific range of scenarios where they get a little bit, have a little bit cold feet about maybe easing too fast and sort of start to kind of slow the pace at which they head towards that kind of long-term neutral setting. So it's not a symmetric range of risks, but I think the best midpoint or the most likely one is around about finishing at that 3.5 range. Now, I'll just quickly finish up on this idea of neutral. This is probably the other question that we get asked a lot. Is actually 2 questions. Is what's your terminal rate for this cycle, 3.5, and what's your neutral rate? And they're not actually the same question, but they are related. That question about a neutral rate is kind of your anchor for where things should end up over the long term, and it's sort of also your anchor for how far they can reasonably go up and down in any cycle. Now, it's a real tough question. I'm not going to give the answer here because there isn't one. It's been debated about a long time about what is this kind of neutral level of interest rates for the economy. I guess the short version is that, firstly, we don't know, we can't see it, we can't even see it in hindsight, and it most likely changes over time. Now, it probably has been trending down over time, so maybe if it was 6% sometime in the past, it's certainly not there anymore. But within that downward trend, we also think that the post-GFC period, interest rates were, really unusually low within that trend. And, our sense is that the 2010s are probably not a great guide for where interest rates will settle going forward. Interestingly, this is not just our view. There was some work recently by, I think it was Rogoff and Reinhardt. They wrote a book a while ago called This Time is Different. It was 8 centuries of financial crises. So the title is ironic, of course, and they've just done one similarly very long-term view, looking at 700 years of history of interest rates, and concluded the same thing: downward trend over 7 centuries, but within that, the 2010s was really abnormal. Yeah, sometimes I get asked, I guess from more the retail crowd, can we expect to have mortgage rates with a 2% in front of them again? And I think the best answer is you'd better hope not, because you think about what it took to get there. So we've kind of taken a house view on, I guess, interest rates in the 2020s, 2030s, probably settling at higher, or settling around higher levels than they were in the 2010s. So for the US, we've pegged that kind of neutral setting at about 3%. For Australia, there's kind of a country risk premium on top of that, so we've said about 3.5. And then for New Zealand, a little bit more risk premium again, so 3.75. Again, not to be too precise about it. But that's our thinking around that. And I think it's a contrast with the markets and with the Reserve Bank. The Reserve Bank's done some methods trying to run filters through the history of interest rates. They've come up with this number that's around about 3%, and I think the rest of the markets just run with that. Fair to say that this issue is not going to be resolved, in the next several years, and certainly not by the time that we see you next. So I'll leave you on that, and I will pass over to Imre to talk about the here and now of interest rates and exchange rates. Thank you.
Thank you, Michael. And we're on to the financial markets crystal ball part of the show. First, a Slido question about the exchange rate. So your chance to try and take my job. Have a guess where we're going at the end of next year. That's quite a long way out, I have to admit, so it doesn't really impinge on my short-term part of the job. Yeah. I think those are all pretty good guesses. Anything around the current level is a very good guess. It's called a random walk, and it's the best thing you can do in financial markets. If you don't know anything, where it's going to be tomorrow or next year is where it is today. Empirically works out really, really well. So anyway, looking at our guesses for the short term, we're only looking ahead 3 months because I'm frightened to go out any further than that. We've got the exchange rates going lower. Not just Kiwi US and Kiwi Aussie, but pretty much the whole shebang. Against sterling, against euro, we're going lower, and I'll explain in a bit more detail why. And I'll also explain there's a really big caveat, which is convenient to have right now. For interest rates, term rates, I think we've probably done our dash in terms of falling, certainly wholesale rates. And I think my best guess right now would be we range sideways before an eventual rise in the year ahead. So a little bit more detail, substantiation, and a look back on how we did last time. On Kiwi US, it actually wasn't too bad a forecast. We forecast it up to 62. It did go up in the first part of the forecast horizon and even surpassed the 62, went up to about 63.5. So that was all right. Then it came crashing back down again. What was that about? That was pretty much all the US dollar strengthening much more than anybody expected, mostly because their economy turned out to be stronger than expected, and so US interest rates rose and the US dollar rose. There's a little bit of Trump stuff in there as well, which I'll explain in a second, but that was the gist of it. Looking ahead to the next quarter, I think the US dollar strengthens even further, and we fall down to 58.50. That's a big line in the sand. If we broke that 58.50 level, it doesn't actually line up quite well on this line, but anyway, that's what it is. 58.50, keep that number in your head. If that broke down, I would start getting more concerned about a bigger bearish case, so much, much lower. But we don't want to get ahead of ourselves. 58.50 is what we're targeting for the quarter ahead. You can see that the US dollar did explain pretty much the fall in Kiwi. US dollar's had a very good rise since September, and that's really all you need to say about this. It's really all the US dollar, or almost all the US dollar. From here, the US dollar should continue to strengthen because the US economy remains in a state where it's panning out to be not as weak as expected, and markets have actually pared back their pricing for the Fed. 3 months ago, they priced in some pretty severe rate cuts from the Fed. They looked outlandish, they dragged those back, so rates have gone up, and I think momentum in that's going to keep going. On top of that, you've got the big caveat, get out of jail card for my predictions, which is the Trump factor. As you heard from Michael, taking on board all of the plausible arguments about what could happen, you'd think it will be a stronger US dollar story. So I'd overlay that on top of this as well to say there's another factor there which could drive the US dollar higher. But you can argue this both ways. You can say things like, well, risk sentiment might just go to the moon, and that's actually bad for the US dollar, which is a defensive currency. But we'll run with that stronger US dollar story for now, for here. Interest rate spreads do matter still somewhat. And the interesting point about that is that New Zealand rates are now below the US rates. It doesn't happen very often in history, but it is happening now. So not only have they fallen, but it means that it's more costly, or it is costly to hold the Kiwi against the US as an exchange rate. So speculators, for example, if they want to have a punt and bet on the Kiwi rising, they buy the Kiwi, they sell the US dollar, every day they hold that position is going to now cost them money. That is a disincentive to hold Kiwi long against the US. So another reason to think that it's going to struggle to have any meaningful rebound in the near term until those yield spreads get back up to their more normal state, which is where New Zealand rates are higher than US rates. But yeah, just back to that get out of jail card, the big caveat on Trump. So yeah, if risk sentiment keeps rising, and you see it's already had a humongous rise already, even well before the Trump factors started to be considered. But he might give it a whole new lease of life, and you see that red line just taking out new record high after new record high. And at some point, you would think the exchange rates like the Kiwi US and the Aussie as well, these are risk-sensitive currencies, they would have to respond somewhat. But for now, and especially over the last year, exchange rates have largely ignored what's going on in the equity part of the world as an indicator of risk sentiment. That may change, but I'm just putting this out as a risk factor. This is one reason why I could be wrong, and the Kiwi could eventually rise if this red line keeps going up and goes up some distance. Kiwi Aussie, the forecast is also lower. How did we go last time? Say this one was not so good. I'll hold myself to account on that one. We thought it would go lower, mainly because of the argument of a hawkish RBA versus the dovish RBNZ, and that was certainly true. But what happened in that initial phase is that the market had a bout of fairly strong concern about the Chinese economy, despite its occasional phases of stimulus that it's been enacting. There were a few wobbles there, and the market got concerned about that, and that hurt the Aussie dollar more than the Kiwi. That passed, and now they don't mind so much. There's a lot more stimulus that's come out of China, so it's not such a big thing. It's holding it for now. The main thing now is we're going back to that RBNZ versus RBA contrast. We're much more dovish than the Aussies, and that is weighing on the cross as we speak. And I think that will be the case over the next few months. So that's why we've got it pointing downwards. Not a big fall, 89 cents. Now, the big get out, actually I'll do this next slide, then I'll talk about the get out of jail card. As you can see, yield spreads here are also in a similar state as they are for the US, where it's now costly to hold the Kiwi against the Aussie. That doesn't happen very often in history. Usually our rates are above the Aussies, but we're now negative to Australia. So another reason why you would not want to hold Kiwi against the Aussie, you'd rather be the other way around. The big caveat here is slightly different to the Kiwi US case, is that last time Trump got in 2016, a couple of years after that, he ignited a massive trade war with China, and that hurt the Aussie dollar a lot. It was very clear to see in our modelling. You can't say, well, what happened there will happen now. In fact, we don't know how severe this tariff regime will be. Will it actually be a full-blown trade war? Will it be something more like a deal? Who knows? I'm taking the view for the next 3 months that we've probably got a wee bit of time to learn stuff. And I mean, Trump's administration doesn't kick in until the middle of January. And until then, there's probably going to be this feel-good factor anyway, just about the fact that we're changing administrations, the equities have responded, sentiment's good. And when sentiment's good, it'll probably reflect on the Aussie more than the Kiwi, which means we'll fall Kiwi Aussie. That's the very near term. But I put out there as a major risk factor, should we get a major trade war, this thing will flip around the other way. The Aussie dollar will get hurt much more than the Kiwi. Okay, on to interest rates. 2-year swap rate had a good fall. It's been responding to the RBNZ rate cuts. Got down to a low of 3.5%. I think that might be the cycle low. We're calling it tentatively. So 3.5 might be it. As you know, markets are hugely preemptive. They take on board what they think will happen for the whole cycle. They don't just wait for the OCR to move and then respond. So they've predicted and priced in the whole RBNZ easing cycle, and this is where they pitch the 2-year swap rate. So I think there's an argument to say this is about as low as they'll go. There's going to be a bit of a wait and see. The next meeting on the 27th of November here will be a very important one because the Reserve Bank will give us its forecast and its new OCR projection. So I think, awaiting that, and probably in the aftermath, if we're right about that, I think these short-term swap rates are going to basically just hover around here. That is the best guess. Interestingly, where market pricing is now, that's the black line, you can see it's basically forms a low around 3.25%. Now that's a bit higher than when we put this up last time. Last time it was about 3%, which is where the RBNZ's got its low, or at least back in August. The market's thinking, no, it's not going to go that low. It's going to be a bit higher, 3.25. And moreover, things are going to basically start ticking up from there. So the market's saying that from about the middle of 26 is when we might expect rate hikes. So they're thinking way ahead. Now that is very interesting because a lot of people ask about, what should they do regarding hedging their loans or fixing their mortgages. We're watching the Reserve Bank. They're still cutting. They're going to keep cutting for quite a long time. Do we wait till they've cut their last or done their last rate cut? And the answer is probably not. Markets are incredibly forward-looking and they're already pricing in a tightening cycle. And by the way, where swap rates are now are pretty close to where Westpac's OCR forecast would imply those swap rates to be. Usually when I put this picture up here, swap rates have been cheap. They've been a lot cheaper than where we would imply them to be. They're all about the same now. So there's no gain to be, there's no advantage or disadvantage in the market as far as we can see. But most importantly, and this is this picture I'll finish on, answering that question, should you wait till the last rate cut? Now, this picture here alone says no, don't wait for that to happen, because what happens in history is that term swap rates, e.g. the 5-year swap rate, and this would apply to the 5-year mortgage rate as well, it turns around well before that last rate cut. How far before? Now, every cycle is different. The most extreme has been 21 months. So nearly 2 years ahead. The average of all of these cycles is 11 months, so roughly a year. So you could take that and say, well, if the market, and even Westpac is saying you might get the first tightening happening in the middle of 26, the markets are going to start reacting to that a year earlier at least, and maybe earlier than that. Don't wait for that last rate cut. Also, you can see not in every cycle, but most cycles, the market actually turns around while the RBNZ's still easing. So incredibly preemptive, and it just says don't wait for that last OCR cut. If you want to fix your mortgage or hedge your loans, start thinking about it now. You've got to make the judgment call yourself, but it happens well ahead of the bottom of the OCR cycle. So I'll finish on that. Thank you.